This cooler than expected producer price report, is it aligned with the consumer price inflation numbers that we did get?
So I think it is in line. I think inflation, what you're gradually seeing is a lowering of inflation, really much across the board. I mean, there's still some sticky components of inflation, like medical services and like shelter, which are keeping inflation more elevated. But what I think is going to be really key for markets is next week's core PCE print, which is going to give a really firm indication of the primary measure that the Fed's really focused on, and whether or not that continues to see, lower numbers, which is what we're expecting. We're expecting a 0.2% on a month-on-month basis, which would bring core PCE down below, the 3% threshold. So it'd be in the upper 2 level. And this is really key for what the Fed is focused on. That said, I still think that market pricing in the front end of the fixed income curve is probably too aggressive. I mean, right now, the market's pricing in 6.5 cuts between now and year end. And we're likely not, I think while certainly March is a live meeting, I think that the market's likely going to be disappointed by the pace and the start of the Fed cutting cycle. It's likely to be pushed back a little bit further into the spring.
How many rate cuts are you anticipating?
Sure. So firstly, I do want to sort of emphasize that we're not expecting rate cuts to start at the same sort of period that the market's currently pricing in. We think it's going to start later than what the market's priced. And right now, when you look at sort of the forward curve, the market's pricing in 6.5 basis points, 6.5 rate cuts between now and year end, starting in March and then being regular throughout the rest of the year. We think that it's going to start much slower, but that once it does start, it's going to happen for a much longer period of time than the market's expecting. So we're really thinking that the rate cuts are going to be pushed out, but last longer.